YouTube, what's up? It's your boy Richardson from Minimum Wage to Millionaire. If you're new here, welcome. If you've been here, welcome back. Let's get straight to it. You read the title. Are CDs still worth it in 2026? So, what is a CD? A CD is a specialized savings account where you would lock your money for a predetermined amount of time, depending on the term length that you go with the CD. And in exchange of locking up your money for a longer period of time, you typically will get a higher interest rate as opposed to regular savings or a high yield savings account. So what are some of like the uses or ways that to explain it better? Let's say you were saving up a down payment for a home and you managed to get the down payment amount. Let's say it's 40,000. So 40,000. But let's say you're like situation has happened in your household. Maybe you decide, hey, let's rent for one more year just to make sure we find a better deal or something of that effect. So you're putting off to buying a home for a year, so you have that money, that lump sum. If you're not planning on buying the home for a year, meaning you don't have an immediate use for that money, and you want to get a higher interest rate, then a CD will be there to help you kind of lock in that money for a year. The principal is safe generally with CDs, right? Because it's essentially a savings account. So your principals are safe. But because you're willing to lock in, the bank or financial institution that's offering the CD, they're willing to give you a higher interest rate versus just putting it in the bank's savings account, right? Where with the bank savings account, one of the cons of a savings account is that the interest rate will fluctuate. So if the Federal Reserve decides to cut interest rates, right? And this will impact savers because generally banks will use the Federal Reserve funds rate as kind of not necessarily they have to drop the rate, but what the Feds does with the Federal Reserve fund rate is generally how banks will influence the interest rates they give both on borrowing products, but also on savings products. And CD will, of course, drop in alignment of that, right? I mean, savings account. Whereas a CD, it's locked. So if the Feds come next meeting and say, "Hey, we're cutting interest rates," you've already got that interest rate locked in, so you don't have to worry about it. So it's good for those cases as well. It's also good for, let's say, people that are trying to retire, probably within a year or two, and they just trying to store a large amount of money so that when they finally do retire, they could leave a portion of their money in investments and hopefully to grow and beat out inflation. And in a portion of investments that are, disconnected from the markets. Because if all your money is tied to the markets and let's say markets going down, even with diversified portfolios, you'll still feel that impact versus, hey, a certain amount of money that you decide to allocate, you and your retirement planner and all that decide to allocate a certain amount into cash. Well, because it's cash, it's CD, and that's pretty much how it's treated. Like, you don't have to worry about those market fluctuations, and that may be able to smooth your overall portfolio in that regard. So there's different cases where CDs may make sense. So to answer the question, I believe CDs does make sense in the two aforementioned scenarios that I gave. I also think it's great for a particular type of person that's not necessarily financial related. And I'll just give you a scenario to kind of emphasize that. So let's say you won the lottery or you received a large inheritance from an uncle or an aunt that you didn't think was balling like that until they were deceased, or some type of large sum that you received. Now, ideally, in a perfect world, you would already have your financial goals assigned and aligned and how your money works and you're in charge of your money. And you could just be like, okay, I got this, received this large lump sum of money from whatever reason. Let me put it to work and get it to work for me. Let's also be honest, right? And let's not be naive. The vast majority of us as Americans, and you could even extend it as human beings, we don't know what we will genuinely do with that large lump sum of money. So what happens is we get that large lump of money and we essentially, as they would say, ball until you fall, right? Basically splurge that money. And right now I'm recording this video towards the end of July. If most of us got $1 million, by Christmas we'll probably be broke because it's just, we have no means to control the money. And I always say, if you're not a steward or you're not in control of your money, then your money's in control of you, right? And you know, what's the saying? Money will be a good slave, but it will be a terrible master, right? So a CD, and how a CD could help rectify this is, let's say you receive a large lump sum, and you're like, you know what? I obviously have financial goals, but I haven't really thoroughly thought them through. So instead of reacting to this large sum of money, let me put it in like a 3-month CD, because CD terms could go as low as like 3 months to as high as, like, I think the highest one I've did my research on was like 15 years, which at that point you should probably get a bond. But anyway, let's say you do it for 3 months. Then when you get it for 3 months, you could say, okay, let's go talk to a financial advisor. Let's go ask for advice around. Let's kind of pick our brains. Let's lay out all of our debts and obligations. Let's see what our financial goals are, and figure how we're gonna divvy up this $1 million. Maybe a third of it goes to paying off debt and obligations. Your mortgage is clear, your student loans, all this stuff, whatever. Maybe a third of it could be enjoyment. Hey, we always want to take 1 or 2 years off work to go travel the world. You could do that essentially, right? And then the other third could be savings and or investments, right? So you could divvy up however you want. But when you first get the $1 million, because in a lot of cases it's kind of somewhat unexpected, you didn't make a plan for it, so you're just reacting. So with that CD, that 3 months, you could kind of take time, right? Slow down, let the euphoria and the dopamine that you get from receiving that large lump sum, let it die down. Let the logic part of your brain kick in. Console with people, wise people that you feel like you could trust. A financial advisor. I'm a Christian, so of course you already know what I'm going to say, right? Pray to the Lord, see what He wants you to do with that wealth, how he wants you to be a good steward of it, and all these things. And once you have that 3 months of just settling down and really thinking things through, now when that money matures, because that's what happens in a CD, you put the money in there, and once it ends the term, the maturity date, you can access that money plus the interest that you were guaranteed. Then you could go ahead on that tack, right? So it's not just this reactionary, because if you put it in a high yield savings account or a regular savings account, yes, you could in theory do the same thing, just leave that money there. But because it's still liquid and there's no friction between you and that money, the temptations are a lot higher. So that's what I think a CD is very, very great for. I know that may not be the best financial decision, because if you're only locking your money for 3 months, you might as well put in a savings. But I always say money's not always what's the numbers say. It's also what's the psychology, what's the behavior behind the person who has this money. Because once you understand the behavior, you may be able to divvy up versus just telling them, okay, these are the numbers, go with it, right? Because numbers don't tell all the whole story when it comes to finances. So just to explain to you guys, wrap it up before I do that and tie everything all together. Generally, there's a few things I want you to know about before you open a CD. Generally, when you have a CD, they're usually tied to banks and financial institutions. There are some brokerages that have CDs that you can invest money in it, and it's just a CD like in regards to that. So there's some IRA CDs which you get, combines the benefit of an IRA, which I'll put in the link in the description below. I've already talked about the IRAs and the 401ks and how that works. It combines that with the CD that we talked in this video and gives you into one. So you do get some tax benefits with that. How well that's going to be, again, I'm not a financial advisor. Please feel free to consult with yours to see if that advice caters to you and your needs. So there's different ones, but generally the CDs we're talking about are ones that are offered by banks, either traditional or online banks or credit unions. And you'll have to usually go ahead and you'll have to pick a term. So they'll offer, 3 months for this much interest rate. Now, the interest rate that you see is what's known as APY, which is annual percentage yield. This is how much interest they would pay you if assuming that you keep that money for a full year in there. Now, this is the trick, and this is how they kind of get you, is sometimes they'll offer very high interest rate for 3-6 months, but you have to do the math. Well, if I'm only holding it for 6 months and the annual percentage yield is 4%, well, I'm not getting that 4% because I'm not keeping it for a full year. I'm only going to get effectively 2% because I'm only keeping it for half a year, 6 months. So look into those rates and understand the math behind it before you jump right into it. And don't let the interest rate just be the end all be all. Another thing is compare the interest rates from a high yield savings account or a regular savings account to your CD. A lot of times you'll have some banks that will say, hey, we'll offer for 12 months 3.5%. So you're locking your money for 3.5%. But then you'll go on an online savings account, right? And I think I did a video talking about how a savings account. I'll put that link in the description below there, and just read the description and you'll see some of the recommended offers. But sometimes these high yield online banks, because they don't have as much overhead as the big banks, they can offer significantly higher interest rates. So sometimes the interest on the regulars, their online savings, not the CDs, just online savings, will be 3.5%. So it's like 3.5% locking my money or 3.5% keeping my money liquid. I think most of us would probably agree we'll take the money that's liquid for the same interest rate, right? Because it's effectively the same. So look into those things. Make sure you're getting at least 0.5% or 1% above what you would get with your regular savings account. That way it makes it worth it to be locked, because if you're just getting the same, it wouldn't make sense. Another thing is because this is closer to a savings account product, make sure it is FDIC insured. Generally, they are, but like I mentioned earlier, there are IRA CDs and brokerage CDs which may not be FDIC insured. So feel free to look at the website and make sure that the product is FDIC insured. And what FDIC insurance just guarantees is that if your bank goes under, if that financial institution goes under, you are covered up to, I believe it's $250,000 for single account, and I think for joint accounts, I think it's $500,000. Again, feel free to do your due diligence and make sure you get that before you put your money in there. And lastly, but surely, is that if in a case that you open a CD, a lot of times there are ways where you could break the CD early. Like I mentioned an example with someone that's looking to buy a house and they're keeping their down deposit on a CD. Let's say instead of waiting that full 12 months, maybe 8 months into that 12 months, they could still access that money if they need to instead of waiting the full 12 months. However, generally one of the cons is that because the CD, they're like, hey, well, you're breaking the CD early, so we'll let you get your money, but a lot of times you have to forego the interest. So they'll say, hey, we're keeping, if you break your CD, 8 months into the 12-month term, okay, that's fine. You'll get your principal, but what we'll do is that we'll take 3 months of interest. So instead of getting paid that 8 months of interest that you locked your money in, they're keeping 3 months of that, so you're only effectively getting 5 months of interest, right? So you have to weigh that in to what you're doing. So if you're in a situation where, let's say, you're trying to buy a home and you're looking to buy a home within the next 2-3 months, it doesn't make sense to lock your money in a CD at that point, because even with a 3-month CD, if you need it a few weeks early, you're going to be foregoing interest, which defeats the whole point of locking it in the first place, right? So just keep it liquid there. So those are just some of the things you want to keep in mind and keep in point when getting a CD. That's all. I don't want to keep you guys too long. Thank you guys. It's Richardson from Minimum Wage to Millionaire signing out. May the Lord be with you all today. Have a nice one.